So tell us a little about your portfolio. Why so few names? Obviously there has been some rumors of the performance up 6% for the first quarter. I know you can't say that's accurate or not accurate. With most of your portfolio up double digits, one down double digits, which we'll talk about. But give us just a take on why so few names and
So for a bunch of reasons. I mean, I've always had the view that, why not own the best 10 or 11 investments as opposed to ideas 12 through 25 or 12 through 100, which is more typical. And, I think there are very few great investments at any one time. So the ability to concentrate is an enormously valuable asset of a strategy. The problem with it is it leads to bumpier returns. And it leads to more attention on mistakes or things that aren't going well. I don't know a portfolio manager that doesn't have a stock that's down in his portfolio, right? But you don't read articles about, we're getting an awful lot of attention for a pretty high profile situation that's struggling. But I think there's, it depends on what your business model is. But if you want to make high rates of return over a long period of time, it's hard to do that being very diversified. I mean, if you look through the Forbes 400, wealthiest people in the world, most of them made their fortune in one business or a portfolio of two businesses. Very few made it in a portfolio of 100. So it's that, and the other benefit, it allows you to run a much simpler investment firm. We have an 8-person investment team. If we had 30 names, we couldn't manage that portfolio the way we do with a small team. By having a small team, you can hire better talent.
There's actually an argument that some people are now making that, buying the index or buying diversified funds have had much better returns than buying, those hedge funds that have, a very specific smaller portfolio approach, like yours.
I haven't seen that article. I mean, I think we've done very well relative to any index alternative, certainly. So it depends on how you judge us. I think if you judge us on a 90-day basis, I have no idea how we're going to do relative to an index. But I think this is a strategy that over time should earn a meaningful premium over, any kind of benchmark. Or you shouldn't give us your money.
Yeah.
What happened was a very simple, relatively safe business that was actually founded, Fannie Mae, right after the Great Depression, to basically create a market for home mortgages. If you think about the problem with the S&Ls, they would take in deposits and make mortgage loans. And in the old days, the banks had to hold on to those mortgages. And if rates went up and down, they could find themselves insolvent by virtue of having lent money on a long-term basis at a fixed rate and having deposits that change in price every day. And really what Fannie Mae and Freddie Mac have done is create liquidity for mortgages and enabled the establishment of a 30-year prepayable fixed-rate mortgage, which became a fixture of the housing market. And that business, their business was basically buying up mortgages from banks, getting up a large enough volume of them, and then selling securities backed by those mortgages where they would guarantee the payment of interest and principal. So very simply, they would buy a bunch of mortgages, chop them up in little pieces, and sell bonds backed by those obligations. And they were in the insurance business, and they would guarantee the payment of interest and principal on these mortgages over 30 years. And it made these securities very safe, and it made them securities that would be, for every bank in the world owns Fannie and Freddie mortgages. Every sovereign wealth fund around the world owns these securities. And that was kind of the safe business. What went wrong was they went off the rail.
Have you ever owned any of these securities?
I've never owned a Fannie Mae or Freddie Mac mortgage. I today am a shareholder of both companies, companies in conservatorship. But just to carry it forward, that very safe business of guaranteeing the timely payment of interest and principal on first mortgages to middle-class borrowers, the management teams decided to get a little more aggressive. And they went into businesses they shouldn't be in hedge fund-like businesses, businesses of betting on the prices of securities and arbitraging their ability to issue debt. And then they were pressed by Congress to make riskier and riskier, guarantee riskier and riskier loans.
So more and more people could own a home.
So more and more people could own a home. So Fannie Mae wanted something from Congress, that is the ability to go into riskier businesses, borrow money and buy securities. And the Barney Franks of the world wanted them to guarantee riskier mortgages. And that combination was a bad recipe going into the financial crisis. And when home prices declined, these entities became insolvent fairly quickly. And
the problem with short selling is it's still not accepted as particularly well accepted as an American way of investing. There seems like something inherently shadowy or evil about short sellers.
You're called an activist. That's quite an adjective nowadays. When you hear this term, what do you think about?
Think about picking another job. No, the answer is, I think, a very interesting presentation from Matt from BlackRock. And BlackRock is built a business largely on passive strategies, and phenomenal business. The vast majority of the capital markets today, the public capital markets, the investors are passive. They're indexed, they're closet indexed, they're index plus an alpha strategy. And if you look at the shareholder list of major companies, it's BlackRock, it's Fidelity, it's Cap Research, it's Vanguard, and by charter, these institutions are passive. If you think about capitalism, 100 years ago, it was very different, right? You had Carnegie, you had J.P. Morgan, you had players who'd buy big stakes in businesses. They were control shareholders. There was an owner on the board of directors. So capitalism over time has democratized, which I think is great for accessibility to the average man in terms of investing in the market. So we look for very high quality businesses, what we describe as simple, predictable, free cash flow generative, dominant businesses, a business that Warren Buffett would describe as having a moat around it, right? If you believe that the value of anything financial is the present value of the cash you can take out of it over its life, well, you need to know how much cash is going to generate over its life. So business quality to us is the single most important criterion for determining what's interesting. Because if we can't predict the cash flows, we don't know what it's worth. If we don't know what it's worth, we can't invest. So we figure out what it's worth, figure out how good the business is, how predictable will this cash flows be from a railroad or a spirits company or a real estate company, shopping mall business. And then we say, okay, well, where's it trading? And if there's a wide gap between price and value, you can buy it for 50 cents, it's worth $1.20, well, then we're going to take a hard look and try to understand why it trades at a deep discount. And once we understand the reasons, we decide, well, these things that we can solve. Or can we, in light of the situation, the circumstances, can we be influential in changing these levers that can cause this valuation discrepancy to narrow? And is this a business that, while we're causing the valuation discrepancy to narrow, we can also perhaps contribute to the valuation growing? And if those things are true, we found something that looks quite interesting for us.
And usually this investment philosophy, does it take a week, a month, 3 months to do the research, a year? I mean, you have 10 names. How long? It
depends. I mean, one of the best investments we ever made, it took us 4 hours to do the work. It was during the financial crisis.
Which was that?
Wachovia Corporation.
Okay.
So I was on my BlackBerry eating breakfast at the Brooklyn Diner in front of my building, and there was a story went across the, I was just, Wall Street Journal headline, Reuters headline, excuse me, went across saying, that Citigroup, to acquire the Wachovia banking subsidiaries for $2 in Citigroup stock. Stock was halted. And this was kind of an interesting transaction because they were buying the subsidiaries for Citigroup stock. I figured, this is interesting. What happens to the holding company? So I went back to kind of went upstairs to the office and cracked open the 10K, and another member of the team, Mick McGuire, he and I worked on it. And what was interesting is the 1,000-page 10K of Wachovia Corporation, I think 900 pages were on the banking subsidiary. There was fewer than 100 pages on the holding company. And by buying the banking subsidiary, Citi was leaving a holding company which had cash, in Wachovia Securities, A.G. Edwards, they had paid $6-7 billion for it 6 months before, Evergreen Asset Management, and they were taking a $27 billion loss on the sale of the subsidiary. And it also had a liability called non-cumulative perpetual preferred stock, which if you ever want to have a liability in your life, this is the single greatest liability to have. It's a form of equity where you never have to pay a dividend, and when you don't pay them, they don't accumulate. Right. And the worst case is they get a couple directors on the board, and you say hi to them each meeting, and you have this very, and I said, look, this could be our Berkshire Hathaway. And at the end of the day, we figured in 4 hours we determined the holding company was worth at least $11 to $14 cash, a tax refund that you could carry back the $27 billion loss, recover cash taxes that have been paid. So you have this cash vehicle. You own Wachovia Securities, which is a good wealth management business. Mm-hmm. You own A.G. Edwards, another interesting asset. These are businesses you know well. And the stock opened after it was halted at $1.84. So we said, look, it's worth 11 to 14, $1.84. We bought 42% of the volume for the next 4 days.
The economy seems to be in a recession, a fairly deep recession, yet the market is almost where it was when we started this recession. Can you explain that, why the market seems to be so much higher than the economy is?
Sure. So, when people talk about the market, they talk about either the Dow or the S&P 500. And the S&P 500 is a market cap weighted index. And what's interesting or fortunate and unfortunate about the crisis is it affects different companies differently. And the more dominant large cap, companies, the stronger the balance sheet, the stronger the market position. Those businesses are huge beneficiaries of the crisis. And what the market does not reflect are small businesses, private companies, more levered businesses that don't have access to capital, don't have the same dominance as the public market. So a business like Amazon, which is a very big component of the market, is up 45%. That does a lot, obviously, for the averages. It's probably something approaching almost 10% of the S&P index today. My guess is 6-7 percentage points of the index. Businesses like Google, Facebook, I think long-term beneficiaries. And ultimately, the value of a business is the present value of the cash it generates over its life. And even if the cash flows are disrupted in the short term, if they're greater in the long term, the values will be higher. So I think the stock market is a snapshot of a portion of the economy. If you had an index of smaller businesses, the market would be down 50, 60, 70, 80%.
So the market also seems to gyrate more than normally. We have market going up 1,000 points, down 1,000 points. Is that because of computerized trading, or why is the market gyrating so much?
Again, the market is a discounting mechanism, and people's estimates of the future have been very volatile. How long is the crisis going to go on for? When will we get back to our normal life? These things affect the input of the model that analysts are using to value securities. I think the other issue is the market in the short term is very much a sentiment index. It's a way for people to express their emotions. And there's been a lot of emotions in the short term. And when that happens, there's a corresponding degree of volatility. But I don't think the market is dramatically wrong. When you look at the market on a company by company basis, when we look at the companies we own, different businesses have been affected differently. Many businesses will be long-term beneficiaries.
Okay, so let's say, Bill, I told you today with absolute certainty, no doubt about it, that the next president of the United States would be Donald Trump. He's going to be reelected. You knew for certain. Would you short the market? Would you go long the market? What would you do?
It really wouldn't change anything that we're doing. Our strategy is to buy super high quality, dominant companies that can withstand a pandemic or a dramatic movement in interest rates that are not particularly exposed to the economy. So who the president is, it's not something that we would make a bet one way or another on the portfolio. I started as an investor. I raised the first pool of capital when I was 26. And I made an early investment in a company called Rockefeller Center Properties. And I saw management making a series of decisions that made no sense to me. And it was just so obvious the right thing to do as to how to create value. And it was being a frustrated passive investor that made me into an active investor. And that investment turned into a very profitable and very high profile investment. And with success, one is motivated to try it again. And it's been helpful to the strategy over a very long period of time. And it's fun. And if you're passive, you can feel like the market's patsy, and if you're active, you can actually create some value. And I think it's a lot more interesting than just picking securities. We bought a stake in Chipotle at a time where the company was struggling a few years ago. We put a few directors on the board. We recruited a new CEO named Brian Nickel. It's completely turned around the company. The stock has almost tripled in the midst of a crisis, and it just tells you that that's a lot more fun and it's a lot more profitable, and it's, I would say, a lot more good for America than just simply being a passive stock picker.
You started in 2004, Pershing Square, with I think $54 million. So if
Yes.
somebody had invested in 2004, part of that $54 million, and they kept it with you, what kind of compounded rate of return would they have today?
You would have about 11 times your money and about a 16% IRR.
Okay, and are there people that have done that kept their money there the whole time?
Yes, the very loyal ones. It's not been a straight line up, to be clear.
Okay, so let's talk about for a moment some of the campaigns you've done as activists. Some of them have worked out, some have not. Chipotle seems to have worked out, but you did a couple that were difficult ones. So Herbalife or Valiant, they didn't work out. What would you say is the mistake you made in hindsight, and that you would try to avoid in the future?
Sure. So there's sort of 8 principles that have driven our investment success. And when we have veered from those 8 principles, we've lost money. And after we went through a very difficult period circa 2015, 2016. The two investments you mentioned were big drivers of that. It was if you will, experiences making mistakes and learning from them, and it was a moment of reflection for the firm. And I went back to the core principles that have driven our success for the first 12 years. And I had a member of the investment team literally engrave them in a stone tablet, not dissimilar from Moses' 10 Commandments. And I had that stone tablet put in what you might call a deal toy, sits on everyone's desk in the office. And we've adhered to those principles, ever since. And, we've been fortunate to return to the success we had for the first dozen years. So I think it's about keeping to our principles are basically, we want to invest in simple, predictable, free cash flow generative, dominant companies with large barriers to entry that earn high returns on capital, that have limited exposure to extrinsic risk we can't control, strong balance sheets, don't need access to capital to survive, have excellent management, good governance. Sounds logical, but occasionally we've diverged, and there's those times. There's a certain discipline that comes with investments, and there always seems to be a countervailing quality that caused us to diverge. But in really each case where we've compromised on business quality or complexity, we've been harmed from an investment standpoint.
And I think the overarching point that the value of a business, unless it's a highly levered, very economically sensitive company, is not particularly affected by the by the event of a recession. Right? If you own the value of a stock, right, the value of an interest in a company is the present value of the cash that business generates over its life. And if it's a business that should exist forever, well, pick Hilton, for example, we can expect that in past history, there's been a recession every 7 or 8 years. Let's assume the future is the same, and there's a recession every 7 or 8 years going forward. That's kind of factored into the value of the enterprise. The only reason why a recession destroys value is if you have a company that is highly levered, and then if revenues decline, their cash flow goes negative and they can't support their debt and they go bankrupt, right? But if you own a very well capitalized business, I don't think a recession has a meaningful impact. It might affect that year's revenues and cash flow, but that's just one line item in a long spreadsheet of cash flows that you discount, if you will, into the present. We have a much larger number of unpaying, i.e. people who share passwords than we thought, or than we at least disclosed previously. This is causing us to reassess our business model. We're going to go to an advertising model. And while we have enormous confidence in a management team that's done a fantastic job over many, many years, it's a completely new approach to their business. And I think for us, it made the future difficult to predict in terms of the future, what's going to happen. And we're a very concentrated investor. We put a large amount of capital in each commitment. We want these to be things that we can predict with a high degree of confidence over a long period of time. And Netflix became, if you will, unpredictable for us. So we sold it. And we sold it around $225 a share. No, $275 a share. Actually, I don't remember a precise exit price. It's trading above the price we exited, but that doesn't mean it wasn't the right decision to exit for us. An investor who owns 100 stocks, there's a place for Netflix. An investor who owns 9 or 10, in light of the uncertainty created by the changes in how they're going to approach their market, we felt it was not something that could fit into our portfolio. In general, we like to own things for the long term. On Domino's, we actually made a profitable investment over the course of the year. Our original holding period intention was not a year, but the world changed in a pretty dramatic way. One, it got a lot more difficult to get labor, a lot more difficult to find drivers, much higher interest rate environment. And the combination of those factors and the valuation that when we sold made it, in our view, just a less attractive opportunity. We'd rather deploy the cash elsewhere. So we put our capital in two places. One, we launched one of the more aggressive buyback programs out there. We're buying in about 1.5 million shares, approaching about 0.75% of our shares outstanding every month. That's a pretty aggressive program. It's about 28% of the average shares outstanding. We think that's the easiest investment that we can make right now. One, we're well capitalized, plenty of cash on hand. Two, we're trading at, as you know, a 35% discount to NAV. Three, our companies are trading at, in our view, deep discounts to their intrinsic values. You get the benefit of that double discount. So we think that's been a good place to deploy capital. The other place we've been deploying capital is some of these sort of more opportunistic hedges. We're investing a relatively small, maybe 1, 2, 2.5% of our capital in each of these various commitments, together comprising at cost, 5 or 6% of our capital, but investments where we can make 6x, 8x, 10x, and sometimes more, that seems a better use of capital for our marginal dollar than the next big equity commitment. And we've looked at, and a couple of things have come closer to prices where we would own them, but stocks haven't really gotten cheap enough for us to take our last dollar and buy the next big commitment. So we've actually made a lot of money on our hedges. So we spend a small amount of capital on investments that have option-like payoffs, and many of them are actually options themselves, not inherently particularly complicated, but a bet on interest rates rising, for example. So a couple of those bets have led to large profits for us this year. We've invested a little under 400 million, and that's turned into about 2.8 billion system-wide. Some of that profit was unrealized last year, accrued into our results last year, and the bulk of it has been realized this year. And those have been some very successful hedges, and we're doing more of that. It's something we've done over a long period of time, opportunistically, and I would say inherent volatility, uncertainty of the world has made a number of those hedges both good hedges and also interesting standalone investments. So anytime you can hedge the portfolio, so for example, we thought rates would rise a lot, and we hedged rates by buying so-called interest rate swaptions. It helped offset some of the mark-to-market losses we've suffered on the long side of the portfolio, but it's also, on a standalone basis, a good investment, and those are the best hedges, ones where you don't mind making a big profit on the hedge, even if your stocks go down, because we think the businesses we own will do fine and recover over time. And in fact, our companies have actually reported quite good results, and so what we've seen is more a reduction in the multiples people are paying for businesses, really no real impact on the underlying companies themselves, at least for our portfolio.
I mean, do you think that the fact there are some investors who don't quite understand the things like swaps and the financial engineering you do in the portfolio, do you think that is a reason behind the double-digit discount to net asset value at all?
I don't think so. I think if anything, people like the fact that we're not just long-only equities in a challenging market environment. They like the fact that we were able to hedge COVID risk in 2020 and turn it into we were up over 70% in 2020, driven by a very successful hedging strategy. I mean, I think the good news here is the people making the investment decisions have enormous skin in the game. So myself and other employees own 26% of the closed-end fund ourselves, and we didn't get that through an option program. We got that by purchasing shares in the open market, and that gives us a lot of skin in the game. So, it's not you should worry if a manager has no skin in the game and they're doing all kinds of speculative stuff. We don't do lots of speculative stuff, and we have a lot of skin in the game. What we do is we invest a small percentage of our assets in instruments that have asymmetric payoffs. So if our interest rate assessment didn't take place, we would have lost $180 million, let's say, on our first hedge, which in the context of a 12 billion of assets is a relatively small sum. But if it pays off, you will notice. And so we like investments like that also offer a hedging benefit. A world in which rates did not rise is probably a world in which our stocks would have done very, very well. So it has the benefit of cushioning the downside. I think the deal is that the government, if you look at the bailout of Fannie Freddie, it looked like the bailout of all the other banks. Think Citigroup. Government injects preferred stock, gets warrants, helps build the capital of the enterprise, tells Citigroup, you know what, we're going to require you to build your capital base to a certain level. We're going to limit your activities to only the safest stuff. And then we're going to, once your capital base gets to a sufficient level, and you don't need us anymore, we're going to either convert our preferred into common, or we're going to sell our preferred in the marketplace or allow you to refinance us. That is the model that was used to bail out AIG and every other company in America, except for one, except for two, Fannie and Freddie. And so $185 billion of capital was injected into Fannie and Freddie. Fannie and Freddie the government's gotten back $265 or $70 billion. Under the original deal, Fannie and Freddie still owe a little bit more because there was a 10% interest factor, more than twice what they charged anyone else, but fine. We've got to pay back the remaining interest. It might be another $25 billion. But what has to happen here is Fannie and Freddie should be limited to the core business they were set up to do, which is to guarantee first mortgages on middle-class housing to credit-worthy borrowers. And that's a safe business. It's a utility-like business. And if they're limited, guardrails around the business, and they have sufficient capital to withstand the Great Flood, what Jamie Dimon would call a fortress balance sheet, and they're watched very, very carefully. You have businesses that will grow in value over a very long period of time. The taxpayer owns 79.9% of these two companies. The taxpayer gets 35% of the taxable income, because the taxing power, so 87% of this thing is owned by the taxpayer. But the taxpayer can't get that profit and the value of the equity without allowing the private or the public shareholders to get their share. And so I think that's how it gets resolved.
The U.S. economy is really the only housing finance market in the world where you can borrow money for 30 years at a fixed rate. And you can borrow 80% of the value of a home. And that ability to borrow 80% of the value of a home at a very low fixed rate, today you can borrow money at something less than 4% on a first mortgage on a $250,000 home, is what really enables the American dream of owning a home. In effect, a very good way to save for retirement. I mean, that simple model is what we need to go back to. And
How do we get back there?
the way we get back there is, so what's happened here is both companies were taken over because they took risks they shouldn't have taken. They didn't have enough capital. The current management teams, which are not part of the political management teams of the past, have done a very good job running both companies since the crisis, rebuilding the capital of both companies. And really the issue, they were headed back in the right direction, which is getting out of the risky businesses, guaranteeing good, strong credit quality mortgages. And then in August of 2012, the U.S. government decided sort of unilaterally to basically take 100% of the profits of both companies forever. So every quarter that Fannie and Freddie generate profits, which has been every quarter basically since 2012, the U.S. government takes out all of the capital institution as a dividend and deprives the entity of an ability to recapitalize. And what should happen is, number one, those dividends should stop. The government's been repaid $240 billion of the original $150 billion of principal they injected into these entities. So the U.S. government has made a very large profit, almost $100 billion profit on the takeover, which it should. The U.S. government and the taxpayers own 79.9% of these two companies, so there's a big opportunity for enrichment for the taxpayer. But they should allow the entities to rebuild their capital. They should not pay any dividends until they get to a level of capital that Jamie Dimon would call a fortress balance sheet. Yeah. And the U.S. government should get out of the business of owning a housing finance company, very much like the banks. If you think about Citigroup during the crisis, the U.S. government did the same thing they did to Fannie, which is they injected capital to bolster the institution. They took warrants, which is a participation in the stock, in exchange for committing capital. And they forced Citigroup to rebuild its capital base. They got Citigroup to exit businesses they shouldn't be in, kind of the higher risk businesses. And the U.S. government sold down its position. The taxpayer exited at a profit, and it was restored to a privately held institution. That same thing happened at AIG. The same thing happened at JP Morgan, Goldman Sachs, B of A. Interestingly, Fannie and Freddie were the only institutions where the government decided after the crisis, 4 years later, to basically take 100% of the profits forever. So it's a unique event in the history of corporate America. Interesting, if you think about the last 10 or 20 years, the price of almost the common things that people need, so the price of clothing, the price of fuel, the price of computing, the price of basic goods and services for your middle class, working class person has actually come down meaningfully, right? We've had a meaningful deflation in the price of most things you need to live a good life. And I think that's partly why, even though there's been very little real wage increases, there hasn't been a revolution, right? Despite that. The risk, however, is really, the only asset I think is at risk of really appreciating dramatically over the next 10 or 20 years, where the middle class gets left behind, is the roof over your head. Because if you don't own a home, you're subject to renting an apartment, and rents have been increasing at very high rates, 5, 6, 7% per annum. And so the ability to own a home and control your cost of housing for the next 30 years or till retirement, and actually build a nest egg with this asset is a very important thing. That's why, why is Fannie and Freddie important? Fannie and Freddie have enabled people to own homes in America, and that's why this is such an important issue. Since the financial crisis, when you had a kind of stable increase in the value of homes around the country over a 75-year period of time, and then you had a massive acceleration in the value of homes in a several-year period of time, fueled by basically no money down, crazy forms of financing. And that blew up because it was a bubble. And then the whole housing market reset at a much lower value. And I think the benefit of becoming a homeowner today is you're buying in at much lower cost. And I think it will be a good investment, like it has been in the past, over the next 10 or 20 or 30 years. Unlike the stock market, where people react emotionally to their stock's going up and down, and they often sell at the wrong time. The beauty of a home is, at a minimum, you have an asset you can live in. You know the cost of, and in the meantime, you can rebuild equity as you have almost a kind of built-in savings plan as your mortgage bill comes in, and you pay a little bit of principal each month. It's a very good way for the average person to put away money for retirement.
I'm hoping he's an 8% shareholder because, as you know, I'm not sure if it's to conceal what the transactions were, but there were derivatives that were used, stock options and forward contracts, and I'm hoping that at this point, now that he doesn't need to conceal his position anymore, that he's converted his ownership into true stock ownership and not just a leveraged position using stock options.
How do you respond to that?
Sure. So number one, here's our position, very simple. We own 2% of the company in common stock. If you throw out the rest of our investment, we're the 9th largest shareholder of the company. So we've got $1 billion or so invested in the common stock of the company. We own very deep in the money stock options that have a term that goes out into late 2020 and early 2021, and those options are over the counter. They are extendable. They're unusual in that we actually receive a pass-through of the dividends on the meaningful percentage of the options that we own. And what that does is it's the economic, these are not speculative options. They're struck at $55, $60 a share versus a stock that's 107. These are options that give, in effect, us it's the equivalent of buying the stock with a 30% margin loan. But I don't like margin loans because margin loans can force you out of a position. And so it just gives us, now, by the way, the stock goes up $1, those options go up $1. The stock goes down $1, those options go down $1. So it's, we own the economics of 8.3% of the company, meaning if the company goes from being worth $50 billion to being worth $100 billion, we're going to make $8 billion. So it's a big commitment to the company, and it makes us. Now, the other thing I point out is the vast majority. Carlos sold a bunch of stock in the run-up on the bounce on the rumor of our involvement. Almost the entire amount of his investment is in the form of stock options. Those options he did not buy; he received them, of course, and they were struck at the money when he received them. He owns a levered position in the company, which is a lot more levered than the one that we have. So the notion that the CEO would criticize us for the $2.3 billion we committed to the company, it doesn't make a lot of sense. And by the way, shareholders don't care. What shareholders care about is, one, we've got a meaningful stake in the business, and we intend to own that stake for a long period of time. Two, the only way we're going to make money here is if the stock does well. This is not a liquid position. We're planning to own this thing for 4, 5, 6 years. So it's really not so much only about this proxy contest. We're going to be here for a long time.
But beyond the money, doesn't this hurt you in a proxy vote? You can only vote 2%.
That's correct. We can only vote 2%. And this is, I think, another important point.
Doesn't it?
On the margin, you could say it does. But at the end of the day, we're going to end up on the board of the company if a majority of the shareholders support us. In some sense, the fact that we're not forcing ourselves onto the board by buying so much of the stock that we're guaranteed to win, right? We're putting ourselves in the hands of shareholders, and we're saying, look, we own 2% of the stock and common stock. We don't have the right to vote more than our position than that. And we want you to decide whether you want a major shareholder on the board, whether you want 2 independent directors with great business track records, a lot of board experience, recent and relevant experience about business transformation. One of our candidates just is on the board of Symantec. He's chair of the audit committee. He was on a committee of that board where they did precisely this. They went and took a look at what is the opportunity to improve the efficiency of our business. They hired outside consultants, and with board oversight, management executed the plan. Paul was one of those members of the committee, and extracted $600 million worth of costs out of Symantec to the benefit of those shareholders. We want to do precisely the same thing here. We thought the fact that Paul just came from a process like that would be very helpful in working with the board here.
I've watched the video that you put out today, a 2-minute video I referenced earlier, where you speak directly to the retail investor,
yes,
which is unique in and of itself. A lot of times these proxy votes come down to the index funds. You speak directly to the retail investor. Why?
Yeah, so number one, the retail investor almost always gets ignored in proxy contests. And part of that is retail investors very often throw out these mailers when they come in the mail. And that's unfortunate because retail shareholders think, look, I own 100 shares. How is it going to matter? Well, actually, if you think about retail investors here as one conglomerate, agglomerated group of shareholders, they're the biggest shareholder by far. The retail community owns 28% of this company. That's a major voting block. And so we're going to reach out to that community. We're doing that with a series of videos. We're going to host, I think, the first ever webcast conference call for retail investors. So we're going to do it at 8 p.m. at night. We're going to do it so that people, after they come home, have a nice dinner, or at least on the East Coast, work is hopefully over. They can come on. They're going to ask us questions about what we plan to do, and our goal is to, explain what we have in mind to the retail investor. And I think the retail investors don't like corporate waste. They probably don't like corporate waste more, certainly as much as institutional investors, probably more.
You wanted to address the fact that ADP and Rodriguez himself have taken shots at your performance. They've done it a couple of times. Do you think your performance over the last couple of years hurts you in this instance?
Here are the facts. So there's a group called 13D Monitor. He's been on your show. I think Ken Squire has certainly been on CNBC. They track all the activists. They've looked at all of our activist campaigns. 146% average return on our activist campaigns. S&P 16 or 17% over the same period. That's number one. You look at our track record from January of 2004, when we formed the firm, to the present. You look at ADP's return from January of 2004 to the present. ADP is up approximately 300% over that period, by the way, including the rise partially as a result of us. Pershing Square over the same period is up 500%.
Because they knock your total shareholder return.
And you know what? You can certainly, we took a major loss, as you're well aware of, and what started out as a passive investment in Valiant Pharmaceuticals, disastrous investment. We own that mistake. That's part of our track record. But even with Valiant, which is included in our 146% average return on investment, we have a superb track record as an activist. Now, what shareholders are focused on, frankly, they're not so much focused on Pershing Square's, they're not investors in Pershing Square. What they're looking at is, are we right or wrong? One of the things we did today is we put out a question for ADP. We've had to do a lot of work to try to figure out the segment margins of employer services business. So there's a small business segment, there's kind of called a medium business segment, there's a large business segment, there's international. The company does not break out the margins. And we said, look, let's put this to rest. What are the margins of each of the various segments? And let's compare those margins to those of competitors. And we've asked the question. And maybe we asked too many questions in our first presentation, so we're just going to ask one. Every shareholder wants to know the answer to that question. The fact that the company's been unwilling to answer the question as to what their margins are by segment tells you something.
Now, this is something you sent out. I have it right here in front of me. You sent this out this morning at 9:30 in the morning. Mm-hmm. And you're still waiting for the answer to that question.
I haven't gotten an answer. You should give them a call.
If only, though, it was that easy with shareholders. You say, the shareholders, they don't care. But do you think that your performance over the last couple of years, the most recent performance that you have,
it's all about value,
makes it more difficult to make your case that some of those investors who think you may be right with ADP can't get past that other part of your story?
The company will try to, if you look at how the company's approached this, we've made a number of very important points. We said, look, you're vastly underperforming your potential. Look at revenue per employee. It's irrefutable. ADP revenue per employee, $162,000. The average competitor, $224,000. 28% less. Explain. Your gross margins are 60%. Your average competitor's gross margins are 74%. Paychecks. 25% of employer services, the core business of ADP, competes directly with Paychecks. They have a product called Run, which competes with a Paycheck product. What are your margins in that business? Carlos says on TV, they're about the same as Paychecks. Well, Paychecks has 41% margins in that business. If ADP had 41% margins in that business, it would mean the rest of employer services has 12% margins, which is a disastrously low number. So look, I want to work with Carlos. I want to work with the board. I want to get beyond a proxy contest. That was our goal from the very beginning. There's always a little bit of emotion. Look, raising with a CEO that, we have in some cases, in some cases we work with management, other cases the CEO is not up, doesn't want to pursue the opportunity, is not up for the challenge. We made changes. So obviously people can react emotionally to that. I totally get it. But one of the things I encourage Carlos to do, and one of the things I encourage the chairman to do, excuse me, talk to the CEOs of companies where I'm on the board. Ask what it's like having me as a director. And universally you will hear that I am thoughtful, that I don't take over the room, that I listen to other points of view, that I'm not constantly calling the CEO. It's very rare for me to pick up the phone and call the CEO of a company we're an investor in. I wait for them to call when they have something where I can be helpful. And that's been my approach as a director. And if only the chairman of this company had made a few more calls about what I'm like as a director, I think this would be a lot more straightforward. But for shareholders, this is about what is the opportunity to make this company the best it can be. And I think by adding an independent voice in the room, someone's made a $2.3 billion investment in the company, committed to be a long-term investor in this business. I think, I don't see how anyone loses. He told me it was a really dumb idea to start an investment fund right out of business school. And he recommended that I go work for Michael Steinhardt or George Soros or one of the other famous investors at the time. But I figured that I knew enough. This is the perils of youth. But the answer is I was an entrepreneur, and I felt that I wanted to approach investing my own way as opposed to learn from someone else. And it's one of the few things you can really learn on your own. You can learn investing by reading books, by reading annual reports, by having you can have a portfolio and invest $100, and you can learn the business, unlike many other businesses which require a lot more. At least that's what I thought at the time.
Okay. So you went far away from just investing in Fidelity type, on a brokerage platform. And Pershing Square has a particular form of investing, which some of our members of the audience may not understand, and it's sometimes called activist investing. So maybe you can just help orient the audience about what exactly does Pershing Square Capital do, what's the general investment style, and why did you set it up that way?
So the vast majority of capital invested in the markets today is passive. So if you think of index funds or ETFs or even the big kind of long-only institutions, the vast majority of that capital is by charter passive. Passive means you do your research, or in some cases you don't do the research. You sort of just blindly follow an index and you're judged based on how closely you follow the index. If you think about investing 100 years ago, though, you had Andrew Carnegie owning 20% of U.S. Steel, or you had J.P. Morgan as a large owner of various companies over time. And in the old days of investing, an owner would act like an owner. So if they were unhappy with the performance of the business, they would replace the CEO. If they were unhappy with the board's judgment, they would make changes to the board. And as capitalism sort of democratized the investment process, and as any kid in business school can open a brokerage account, and as the owners of many of these great businesses over time, gave the shares away to a university or their heirs, and the ownership was spread out, the Sam Waltons of the world kind of passed away, and the boards became to be managed by professional owners. And so what we do is we look for situations where a business has lost its way, where an otherwise great company in a business that we would define as one that has significant barriers to entry, that Warren Buffett would describe as having a moat around it, a business that is simple, predictable, generates cash, and we can be confident we'll be here 50 years from now. A good example is we own a stake in Canadian Pacific, which is a railroad in Canada. And if you think about the railroad business, it's a business where they're not going to build a new one across the street. You can have, absent some fairly dramatic changes in technology, you can be pretty comfortable that goods will be shipped on rail for a very long time to come. So it's a business we can predict. We can think about it from a very long-term perspective. We can buy it at a price that's interesting. And in the case of CP, this was the worst-run railroad in North America. It had the lowest profit margins. It was trading at the lowest valuation relative to earnings, and had a very unhappy shareholder base, but there was nothing they could do about it because they were inherently, again, the biggest investors tend to be very passive. And we saw an opportunity, and the opportunity was if you could replace the worst CEO in the railroad industry with the best CEO in the railroad industry, a lot of money could be made. And we bought first 12% of the stock and then another 2%, so about 14% of the stock. We recruited a guy named Hunter Harrison, who is widely considered the best railroad executive of all time, certainly in North America. He had retired at 65. He was 66 and a half. He had signed a 2-year non-compete with his employer, and I think the biggest mistake they made was a 2-year non-compete because he was running the other Canadian railroad, Canadian National. And we hired him as a consultant. He helped us study the railroad, and he had plenty of fire in his belly. And we said, look, would you be interested in the day job? And he said, let me check with my wife. And she said, you know what, it's time to get you out of the house again. And
my wife says that all the time.
And we recruited him, and then we had to simply put him in place. Now, the problem was Canadian Pacific has one of the most sort of esteemed and illustrious boards in Canada, at least at the time. And it was the former head of the Royal Bank of Canada, the former CEO of Suncor Energy, the former head of the steel business. It was a very, very important board. And they didn't like the idea that this idea was coming from outside the company, so they said no. So we went to the shareholders and we ran an election, a proxy contest. We put up 7 directors for 7 seats on a 13-seat board. And the shareholders voted with us 90% of the time and voted against the other guys. And they got between 3 and 11% of the vote. We put our directors on. We did a review of the best CEOs in the world. Turns out the guy we identified was the best guy. We put him in as CEO. That was 16 months ago. And it's almost the most profitable railroad in North America after 16 months. That's how quick this guy goes to work. Stock's gone from $46 to $151 a share. It's, a little under $8 billion market cap to a $25 billion market cap. And that's kind of the perfect example. Now, it doesn't always work that way. And I have a feeling that Peter might ask me about one of those cases.
So I used to cold call Bill as a student, so this is going to be fun. So it's very clear you've had notable successes. Bill's own estimation is 23, 2, and 1. Is that, do I get the numbers right?
24, 2, and
24,
1, but who's
2, and
counting?
1. 24 wins, 2 not wins, 1 tie, something like that. And Canadian Pacific is clearly a win. I think you just monetized $800 million. That's what I read in the papers.
They sold about $1 billion of stock.
And then MBIA is another one where Bill was prescient about the fact that the financial markets were going to, well, that MBIA, which is a large insurance bond insurer, was in for a bad ride, and you figured that out. But there are some, the 2 and 1, where I think what you've said in some of your recent things, where you've had some things that you've learned from those experiences. They might include, for example, JCPenney, that's been in the news this summer. So what have you learned from the successes, and then maybe what have you learned from the ones that haven't been successes?
Again, as I said at the beginning, experience is making mistakes and learning from mistakes. And unfortunately, as students, you haven't made many mistakes yet. If you've gotten to Oxford at this point in your career, the biggest risk is you probably haven't screwed up a lot. And so, the risk of that is when data comes across your desk that's inconsistent with your being successful, you're less likely to pay attention to it than if you've made a few mistakes. So I encourage you to make some mistakes. Actually, I've made plenty over the course of my career, and I think I've been very successful over time, but it's not been a straight line up. In fact, if I were a stock, it would look something like this after business school, and then, so the concern is whether this is coming, But so far, we've the overall trend has generally been positive, but there are certainly bumps along the way. And JCPenney is a company that we invested in that we knew on the way in was a much higher risk situation than a Canadian Pacific. So JCPenney, for those of you who are not familiar, is a 112-year-old American sort of iconic retailer that's certainly way past its prime. It probably peaked 25 or 30 years ago. Again, another example, you had James Cash Penney, who founded the company. He died, I think, in the early 70s. And there's a pretty good correlation between when the founder goes and when the company goes. And part of that has to do with governance, which is a topic I'm sure we'll get to. But the time we invested, JCPenney stock was down from $80 to about $20 a share. It was trading at about 4 times operating income. It had lots of assets lying around in the company that were non-core assets. It had a very bloated expense base. And it was generating very little sales per square foot. It was a very underachieving retailer. And part of that is the brand had become somewhat tired, and they had gone to a very highly discount-oriented model where they'd mark a dress at $40, and they wouldn't sell any at that price. And a week later, they'd mark it to $20, and they probably wouldn't sell many at that price. And then they would send you a coupon where you got $10 off, and then they start to sell a few. And then if you used your credit card, you got $4 off, and if you bought this moment, you get another $5 off. And eventually, it was $8 or whatever, and they sell a lot of them at that price. And but this was undifferentiated merchandise. And the thesis was this company has actually still a brand, well, faded, restorable. And because they were created over the last 112 years, they actually own about 112 million square feet of some of the best real estate in the shopping mall, in the shopping real estate industry. They own or have very long-term leaseholds at very low rents. And we said, look, this is a great platform to rebuild the company. And we bought a 16% stake in the company. I was invited to join the board. I joined the board with a friend who bought 10% along with us, so we owned together 26% of the company. We both joined the board. We were 2 of 11 directors. And the CEO was 64, and the board was very much focused on succession, as any board should be generally, but particularly when their CEO's in his mid-60s. And we helped the board with succession, and there was a candidate that kept surfacing as the best guy in retail. And this guy's name is Ron Johnson, and he had an ideal background. He didn't go to the Oxford Business School, but he went to Harvard Business School. And he graduated, he went to work for Mervyn's. His dream in life was to reinvent the department store. And Mervyn's was kind of a dying department store. It was acquired by Target. So he spent a few years at Mervyn's. He spent 10 or 11 years at Target, which is probably the best run U.S. discount department store. And then he was hired by Steve Jobs to build the Apple Store from a blank sheet of paper. And he did an absolutely incredible job. And we said, look, you couldn't ask for a better background to do what we're trying to do here, reinvent the department store. combine the Apple customer store experience with kind of some of the Target brand excellence and cost management. And the problem was recruiting him. He's very happy living in Atherton, California. He had $400 million of restricted stock in Apple, $100 million of which he was going to lose if he left. And he had kids who were in 13, 15 years old, in the middle of their, at a time when parents don't like to move. But I managed to convince him to take the job, and he walked away from $100 million in restricted stock. We gave him $50 million to make up for it, but he still took a loss when he took the job. And then he invested $50 million in 7-year options that he bought with his own money that he couldn't sell for 6 years. So I thought this is the absolute perfect thing. We have the best guy, we've got a great platform at a really cheap price, we have the perfect alignment of incentives, and I thought, it's done.
But it didn't work.
But it didn't work. And so Ron got started in November of 2011, and he proceeded to make a series of changes, many of them very favorable. Among them, he took a very hard look at the cost structure and found about $1 billion that he could take out of the cost structure of the business. We took a hard look at all the non-core assets, and we monetized about $600 million of the non-core assets. So far, so good. And then he launched a business plan to convert the JCPenney store into basically a mini shopping mall, a Selfridges type model where there were a series of brands, each of which would have their own kind of presence in the store. And then you'd have a consolidated checkout with a wireless experience and sort of this Apple-like customer service experience. And he sold this idea to brands that heretofore wouldn't be willing to go into JCPenney. And the guy's very charismatic. It was a great idea. And he had a whole bunch of brands that he got from around the world who were excited about opening up inside JCPenney. And he went to work. But he made one very significant strategic mistake. This whole notion of what he almost called fraudulent pricing, this overpricing an item and then marking it down and coupons. He said, look, this is a waste of time. Let's just market at the price. The consumer knows the fair price. Because when you looked at those $40 dresses and $40 shirts, they all sold it for something like $12.30 on average, and very little sold at any other price. He said, let's just market at $12. The consumer understands value. We can save a huge amount of, the company had spent an enormous amount of man hours actually changing signs. If you think about how often they're constantly repricing and reticketing and changing signs, the stores look really cluttered. And, it sounded like a brilliant idea. And the Apple experience was not about testing. So instead of trying this out in 1 or 2 stores or in a region, he rolled it out across the country. And it failed. And the customer who had become accustomed to getting coupons in their Sunday circular, all of a sudden the coupons weren't there, and so they decided not to come. And we lost about 1/3 of our customers after about 12 months. And the great thing about a retail business, if you get it right, is this business has enormous operating leverage, right? Because you've got a substantial fixed cost base, but once you start generating additional sales, it almost all drops to a lot of it drops to the bottom line. Well, only problem with leverage, as you learn in business schools, it works in reverse. And so all of a sudden the company was losing huge amounts of money after having spent a ton of money on capital rebuilding and redesigning these stores. And we found ourselves in a turnaround 15 months after he was hired. And we had to replace him.
And the lesson?
There are many. So number one, this was what I call an extreme makeover of a company. And when you do an extreme makeover, it requires perfect board alignment and backing for the CEO. And we didn't have that. Number one, we were one of 11 directors on the board. And there was still had it worked perfectly from the beginning, there wouldn't have been a problem. As things got dicier, there was a divergence of opinion on the board of what to do and when to do it and who to hire. So I think that's one interesting lesson. I don't think I'll ever go on a board and be one of 11 anymore. I like going on with a mandate like in Canadian Pacific. Two, I think Ron is an incredible talent, but I don't think, like the students in the room, he'd ever made a mistake before. And I think it was, as the data kept coming back, Ron still had a lot of confidence it was going to work. And you've got to back your CEO and give him rope. And I think Ron will be, and I think he'd say this today, he'll be a much better CEO the next time because having had a big negative experience like this. I think third, retail is one of the businesses where you can really test, right? You can take a region, you can take a store, and you can try things out and rejigger them and test them. And I think, the Apple experience, Steve Jobs was all about the customer doesn't know what he or she wants. I know what the customer wants. And Steve Jobs, got it right. I think in retail, there's a kind of a saying, the customer knows what he or she wants. And I think you really have to listen to that. So while I still love the vision for JCPenney, I think it was right. I think the execution was difficult. To do something like that, and also in the public domain, right? This is a major change, and the company was constantly being harassed by the press, and Ron was attacked. I think it makes it difficult to make decisions in that kind of a public context. There's a lot. I could use up the rest of the lecture here with that other ideas.
You know, what's amazing for the audience is this is on the bad side of the ledger. And Bill, you know, you being so frank about what worked and what didn't work. I think this is how we learn in a business school, because even though you may not have failed yet, you know, us old guys typically have, and we have an opportunity to do that.
Actually, on failure, just for a second, I don't know. There are very few people. You look at the most successful people in the world. I know very few of them that haven't had a major failure. You know, if you read through they're not the financially most successful people. If you read through the Forbes billionaire list and you read their stories, you know, they've had failed businesses and they've lost everything. And you know, my approach in business, in my personal life, in a management role, is extreme candor. And I think that if you live that way, you know, you'll run the risk of offending various people over time. But you'll have much better relationships because, you know, if you tell people the truth, first of all, it's not typical. You know, a lot of people, in the interest of politeness or fear of confrontation or it's just uncomfortable, don't speak the truth. And that goes for people on boards. You know, there are lots of examples of super talented people sitting around the room as an institution is failing. Think of all the banks during the crisis where people were not willing to confront the CEO. So I'm willing to confront the CEO but I'm completely candid with him about his successes and his failures, but I give him, you know, I don't I don't run the company. I'm not involved day to day at all. I trust his judgment. It's a bit of a trust but verify type relationship, and it's worked very well. So that's my only public leadership role. I am CEO of Pershing Square. It's a much easier business to run than a normal company because we've got only 56 employees. And here the key to successful leadership is, one, hiring the right people. I have the benefit of not inheriting anyone because I hired everyone in the company. I interview every receptionist, I interview every secretary, I interview every investment person. And so I get to pick ultimately everyone that I work with, and that helps leadership a lot. Because if you hire, the key behind leadership, if you hire super talented people, you don't need to do that much leadership because they're going to do the right thing. Second thing is setting up the incentives correctly. So in Pershing Square, everyone is incentivized by how the overall firm does, which I think is a good dynamic because it creates teamwork. I follow the same extreme candor approach in evaluating people. And I care about everyone I work with as I do of family members. And so we look out for each other, and if someone's going through a difficult health issue or personal issue, financial issue, or you know, I have the benefit of having a lot of relationships, and whether it's the medical community or in the business community or in the political community, and so we help our people, and we don't tolerate insincerity. You know, people are encouraged to admit their mistakes immediately before they figure out a solution to the problem. So when I hired my CFO, in the first year of working with him, he would approach me with a mistake he had made after he had figured out how to solve the problem. And I would get angry with him every time. He said, no, I don't want to hear about the mistake after you figured out the solution. I want to hear the mistake now, and then we can work together on solving the problem. So I think if you have an organization where people very quickly admit mistakes, and where you're candid with them, and they're not punished for making a mistake, that is a very good dynamic. And it's worked very well. We have almost no turnover even in the reception desk at Pershing Square, and that's worked. It's been a good model. And so I don't do that much leadership, other than I guess on the leadership side, I think you have to, you have to set an example in terms of the way you live, in terms of the way you behave, because that affects how other people will watch you. So my other key success factor for being a leader in the 21st century, in the era of everyone having a video camera on their cell phone, is assume that everything you're doing is being videoed and recorded at all times, and that will, and consider that the video ends up as a top video on YouTube, and then adjust your behavior accordingly. So.
Fair. You are being videoed, by the way. So, if I'm correct, all or almost all of your investments have been in North America. But I note that you're creating a new fund that will be listed on the London Stock Exchange with an eye to raising money from the global capital markets. Any observations on opportunities for your kind of investing outside of the Americas?
Sure. I think there are a lot of opportunities for shareholder activists in markets outside the United States. The reason why we focus on the U.S. is because there's a lot to do. It's close to home. I speak the language, understand the law. We're very well known in the United States. I know every CEO in America knows who I am, so if I pick up the phone and call, I'm going to get a returned phone call. And we do so few things a year. If we do 3 things a year, that's kind of a big year for us. So we have a lot of wood to chop before we need to go far. And as much as it's fun to come to Europe, I'd rather come here on vacation than to come here for a proxy contest. And if you have a problem, by the way, so JCPenney was a problem. I spent a lot of time in Texas, but Texas is a lot closer than Japan or Italy and so on.
Maybe not culturally.
Yes, exactly. All of that said, and I think the U.S. Shareholder activism has become very well known and understood, and directors are very responsive to shareholder activists. Whereas I think Europe is probably 10 years behind in terms of the degree of shareholder activism and how directors respond and precedent and so on. So I think it's harder here, but I think it's going to happen, because I think passive investment management as a long-term strategy is not a great long-term strategy other than in bull markets. And so I think the demand for returns to meet pensioners' obligations will make shareholders inherently more proactive and unaccepting of underperformance. So I think the typical sort of point of view in the United States has always been, well, our government's not that particularly well run, but it's such a great country that it doesn't really matter. And I think it's increasingly matters. So if you think about the United States as a business, right? We've gone from being very conservatively financed to approaching over-leverage. The governance structure is inherently dysfunctional in terms of our ability to make decisions about even meeting our contractual obligations to our bondholders. I mean, the fact that we had a debt ceiling crisis only a couple of weeks ago is a perfect example. That we imagine launching a business appealing to like 100 million new customers, and the website going down the first day and not working for like a month. Okay, imagine if that happened in the private sector. Would anyone keep their job that worked for that business? I mean, I think that our government has not shown itself particularly effective at things business, and I think the running of the country, a huge part of that is the president is the CEO of America, and he's responsible ultimately for how the website works. It's like Jeff Bezos. The website goes down, you don't blame the CTO, you blame Jeff Bezos. I think that what I like about what I do is we can work to make business more effective. And at some point, it'll be time for someone to take my spot. And the question is whether I can be helpful on government. And I don't know what the right role would be, but it's tough. Having been, the benefit of where I am now is the buck stops with me. The question is whether I want to work for someone else. And so I guess I either have to be CEO or maybe I have to find something else to do.
Okay. We're waiting for the post of CEO USA here, so that's coming.
They should have that post. There should be the president, then there should be the guy who runs the business of the country.
Or chief operating officer.
Seriously.
So we'll suggest that next time.
The president can shake hands, he can attend funerals.
Okay. There you go.
Someone should run the country. Yeah.
I would be remiss if we spent this time together and we didn't talk a little about Herbalife. For those of you who don't know, and Bill was going to explain more, this is a direct selling scheme, which the day I came to see you in New York, you were about to, or that day you were launched your PhD-length report on all the various problems with Herbalife. You then had a substantial short position for those of you who don't know finance. So that's basically setting a position such that you benefit if the stock goes down. A very public and nasty battle with Carl Icahn. And then the last few days, I see restructuring your position from shorts into put options. Forget about that for those of you who don't worry about finance. And one element of this deal, which was extraordinarily novel, I mean, the whole thing was novel, was your announcement that you would donate your profits from the trade to charity. Can you explain what's going on at Herbalife? And in particular, maybe focus on that last piece, which will be a bridge to some things on philanthropy. What were you trying to accomplish? And what was this announcement about donating profits from the trade to charity, and why did you do that? Okay, so as you mentioned earlier, so about 11 years ago, I came out with a white paper called Is MBIA AAA, where I questioned the AAA rating of a company called MBIA. I disclosed on page 1 of that report that I had shorted the stock and bought CDS, a kind of an insurance product betting on the company's
credit deterioration. And caused a bit of a stir with this paper. The company did not like the paper. And they, as the largest guarantor of New York State and city bonds, decided they wanted to get back at me. And they called up Eliot Spitzer, who was the then presiding attorney general in New York, and said, look, there's an evil guy saying that we don't deserve our AAA rating. And Moody's and S&P say we're AAA. Who's this guy? And Moody's and S&P would later lose some credibility after this. But this was a 150 to 1 levered company. It was guaranteeing a whole sort of very risky subprime CDO, CDO squared, CDO cubed, and so on and so forth. And it was insolvent based on the exposures, and a good analyst digging deeply could determine that. And I came public with this, and I was largely ignored. And I kept at it because I'm a persistent guy. And I made a series of presentations. I'll see if I remember some of the names of them. But anyway, so I made a series of presentations. And no one was really paying attention. The stock was 73. The insurance just kept getting cheaper and cheaper, meaning no one believed that we were right. And one day at my last presentation, I said, oh, by the way, no one ever believes me on this one. They say, well, you're short, so how can we believe you? Because you're going to profit if it declines. So I said at a conference, I said, okay, I hereby commit to give away 100% of any personal profit I make from this investment. That day was the high for the stock, and it went from 73 to $3 a share. And the credit protection went from 13 basis points to 2,500. We made $1.6 billion or $700 million. I personally made $150 million. And the $150 million seeded was really maybe the second or third grant, but the big grant that created the Pershing Square Foundation. So the Oxford program is an indirect beneficiary of the failure of MBIA.
Thank you. The failure of the financial system actually has a silver lining. I love that.
So the problem with short selling is it's something that, even though it's perfectly legal, it's something that people have a degree of discomfort with. It's almost perceived as un-American to bet against a company. And we, by the way, only do it in very rare circumstances, and generally only when we believe when it's good for America or good for the world for the company to disappear. And so in this case, you had a company that was assuming more and more credit risk and had only a tiny capital. They had $5 billion of capital and $1 trillion worth of obligations they were guaranteeing. And because they were AAA rated, banks and other institutions were not holding capital against these exposures because regulators say if it's AAA rated, you don't need to hold capital. So this was creating, in fact, in my testimony to the SEC, and there's a book called Confidence Game, which is about my battle with the company. And if you go to the Confidence Game website, all of my transcripts of testimony to the SEC and the Attorney General, actually online, you can read them. And in there, and this is early 2003 timeframe, I said there's going to be a credit crisis if you don't shut this company down. No one paid attention. Anyway, I came across a company. Anyway, so I think the giving away of the profits made people say, look, maybe this guy actually believes what he's saying. People paid a little more attention, and I think that helped. And it's probably going to give the money away anyway, so it's easy to give away when you don't have it. After you receive the $150 million, then it's really, oh, okay. So the second time round of consequence is a company called Herbalife. And Herbalife is a company that's reportedly in the nutrition business. They sell protein powder shakes, they sell vitamins, they sell herbal tea, they sell some nitric acid type things that supposedly are good for your heart. These are all commodity products. They're made by 5, 6, 10 different manufacturers. You can buy them at your local pharmacy. You can buy them at your local GNC if they have that here. You can buy them at your local supermarket. But the price you pay at your supermarket is about a quarter to a third of the price you pay for the Herbalife products. So who in their right mind would buy this overpriced stuff? And the Herbalife's number one product is called Formula One. No one's ever heard of Formula One other than the race. And it competes with a product called Slim Fast, which I guess many people in the room may have heard of. It's a product made by Unilever. Slim Fast sells 100 million, 150 million a year. Herbalife ostensibly sells 2 billion of the same product. Now, how is it that Slim Fast sales have been coming down every year, and the Herbalife product has been growing? It's sold by what they call a direct selling model, and the way that works is, your name is? Marianne. So Marianne comes to me and she says, Bill, don't I look terrific? I've been losing weight. I've got this product I've been using. And I said, wow, you look fantastic. And she said, would you like to try it? I said, sure. A friend approaches me, and says, hey. And so you try it. And then she says, hey, would you like to make a little money on the side? And in this economy, who wouldn't want to make a little money on the side? And she convinces me to become an Herbalife distributor. And she tells me that if I sign up 5 friends, and each of them sign up 5 friends, and each of them sign up 5 friends, pretty soon I'll be collecting royalties, and I can retire rich, or if I'm less ambitious, I can make some little money on the side. And as a unsophisticated, unemployed, low-income person, which is the target audience for Herbalife, this kind of pitch from someone I trust sounds appealing. And the unfortunate thing is that something in order of 99% of the people lose money. There are about 50 that make 5 or 10 million a year. There are about 1,000 that make a few $100,000 a year. And the other 3.6 million lose, anywhere between $300 and $3, $8, $10, $20, $30,000. And it's really a money transfer scheme. It's a pyramid scheme. It's like a chain letter. When you got one when you were a kid, send a dime to the following 11 people on the mailing list, and then in 3 weeks you'll have $1,000. If you think about what a Ponzi scheme is, it's a money transfer scheme without a product. A pyramid scheme is a money transfer scheme with a product. And they do smart things like put the Herbalife logo on football jerseys of famous soccer stars, and they back various teams. That's very appealing to the Hispanic community, which is actually the target audience that they've been very successful with. Now, unfortunately, or fortunately, pyramid schemes are illegal. Now, here's a pyramid scheme. It's got a $7 billion plus market cap. It trades on the New York Stock Exchange. It's been in existence for 33 years. How is it possible that this company could be a pyramid scheme? The answer is, it is. And in fact, they've used their tenure as a public company and the New York Stock Exchange listing and the imprimatur of a Nobel laureate they paid $15 million to serve as representatives of the company, and lax regulatory regime in the U.S. to allow this pyramid scheme to grow to an enormous size. And the problem with pyramid schemes is they run out of victims and they inevitably collapse. And I can actually prove to the audience very quickly that this is a pyramid scheme. And I'll do that by asking you a question. So Herbalife entered the UK in 1983, 30 years ago. Okay? Pepsi has been in the UK for a longer period of time, but after 30 years, Pepsi had a good quarter last quarter, and they grew their sales at 3% in the UK. What do you think Herbalife grew their sales last quarter in the UK at? Let's have a guess in the audience. Raise your hand. It's no risk of being wrong. Yes? 1%. Okay. Someone else? 140%. That's interesting. Okay. 20? 30%. The answer is sales grew 92% last quarter. And how is it possible that, maybe people are getting fat at an incredible rate here. But absent that, the reason why it grew very quickly is they found a new immigrant population to go after. And this is a product where there is a boom as people get recruited, and then very quickly, when the population gets saturated, it collapses. Right now, the UK business grew enormously and then collapsed, and now it's beginning to grow enormously. It's maybe the Vietnamese population. I was with one of my investors and said, I think the women who work cleaning the office are Herbalife distributors, and I met with them. And people are convinced to become Herbalife distributors that you have to buy $3,000 worth of inventory in order to start getting these royalties. And what it is effectively an inventory loading type scheme. So anyway, so that's what the business is. We did probably 18 months worth of work before we came public. We hired one of the best law firms in the country, Sullivan & Cromwell, to do their own independent evaluation. If I'm going to say publicly a company's a pyramid scheme, I certainly would like the legal backing of one of the top law firms in the country. And both we and Sullivan concluded it was a pyramid scheme. And on December 20th, I made a public presentation. And there's a website called Facts About Herbalife. You can watch the presentation. There's lots of other data there. And so far, so good. Until Carl Icahn came along and bought 16% of the company, said it was totally wrong. And it seems like every day he goes on CNBC and says what a great company it is. And every time he says that, the stock goes up another couple of dollars. And in the meantime, the company's reporting very good financial results. But I'll make a prediction, and I don't know if I'm back here in a year. Maybe
we'll invite you back.
Okay. This business will be shut down. Okay. This business will collapse. I can't give you the precise date, but we will have made progress to that in that direction within 12 months. So that's my prediction for today. And the profits will go to the Pershing Square Foundation, and maybe Peter will have some other idea for another Oxford program.
There you go. Which is a great segue. So, Bill, you and Karen are kind of, you signed the Gates Buffett Giving Pledge. Your family's made a substantial commitment to giving away your money. We can talk about that in general terms, but let's make it more personal here. You were kind enough to fund these 1+1 scholars. The whole point of these is, people are going to study depth and breadth. And then go off and change the world. 25 years from now, you'll be in your 70s, I think.
I hate to admit that, yes.
Okay, fine.
72 to be exact.
There you go. So you're still young enough to be on the stage. 25 years from now, we have a stage full of one of Pershing Square graduate scholars. What will they have accomplished? What do you want these people that you're funding to have done in the world?
So what's interesting is there's an enormous leverage in people that, in a single person, right? There are people that change the world. And a good example of that, and I'll give an example of someone who might go to the program someday or with someone like this. So we were talking about Wendy Kopp earlier today. Wendy Kopp founded something called Teach for America. I was at the organizing meeting for Teach for America in 1990. A friend invited me to come. And she got a group of friends together, talked about the education system in America, about how the best and brightest have not been going into teaching for a very long period of time, how she wanted to change that, how she had an idea to solve the problem, and she wanted to start something called Teach America. It wasn't actually Teach for America back then, until they decided to form this thing, and then, I don't know, 6 months in, someone else had the name Teach America, so they changed it to Teach for America. Anyway, so Wendy Kopp has built a massive organization that recruits, I think something on the order of 10,000 kids right out of college to go into teaching for a couple of years, typically in very difficult neighborhoods. And they teach math, and they teach science, and they teach something related to their undergraduate degree. They get exposure to teaching. They meaningfully improve the teaching quality for the schools they participate in. And a very high percentage, something like 65% of them, go on to careers whether in teaching or in managing schools or in just the education field generally. So if you think about the multiplier effect of what Wendy Kopp has achieved, I think it's been a very big thing for our country. And she's now doing something called Teach for All, and she's launching Teach for America in China and in other countries around the globe. So I think that's a great example of someone that might, and again, scaling a business like that, and that's a business, even though it's a not-for-profit business, is something that Wendy had no experience in whatsoever. And she was fortunate in having good board members and directors and teaming up with the right people. But there are a lot of people that have incredible ideas on how to change the world, but no experience in, some of the people with the best ideas have the least amount of experience. And, the idea behind, an MBA program is to try to give you in a short period of time real-world experience that you can then apply. And so Wendy's a good example. Another example might be a guy that we've backed named Andrew Yoon. And Andrew Yoon started something called the 1 Acre Fund. And Andrew was in Kenya, I think, on a holiday, and he noticed all of these 1 acre farmers who are basically women, mothers, that feed their family 9-10 months out of the year based on the output of the 1 acre of land the government gives them. And then their family starves the other 2 to 3 months of the year because the crop output is not sufficient to feed the family. And they use very primitive farming techniques, and they use very primitive seed technology and very primitive fertilizer, and the result is a very inadequate crop year after year. What Andrew said was, what if we could teach people better farming techniques, better irrigation techniques, get them access to better seeds that more virus resistant and so on. And he built an organization called the 1 Acre Fund, and he's now trained 130 or 40,000 of these 1 acre farmers, and he's actually built an organization that has a field, it's got an organizational structure like a big company that's servicing these 130,000 farmers. He's grown at something in order of 50% compounded for the last 5 years, one of the fastest growing businesses. And he's self-financing, because what he does is so you take the initial output, your average output was whatever many bushels of corn, and he says, look, I will provide you with better seed technology, better fertilizer, better access to markets, and you give me half of the increase in output as compensation for what I give you. And the farmers sign up for this deal, so they're able to reinvest the profits from these more profitable farms into helping more farmers. And we provided what amounts to a revolving working capital loan that he uses to buy seeds and fertilizer, and then he recovers the capital when the crop is done. Again, brilliant idea, and growing at an enormously rapid rate. He's got a shot for the Nobel Prize, I think. So that's another potential. Imagine what he could have accomplished with his Said degree.
Absolutely.
And let me give you one more example, because not all of these are going to be not-for-profits. And one quick thought on not-for-profits. I think not-for-profits are generally a worse way to approach a business problem than a for-profit. If you think about the typical not-for-profit, it generally has people who are undercompensated. They don't have a profit motive, so it's actually in many cases it's difficult to define success, to judge the progress of the business. The boards of directors tend to be less attentive. They tend to be too big. They tend to not pay as much attention. There tend to be a lot of other companies in the same sector pursuing the same areas, but there's no M&A activity. So it's not the typical not-for-profit is a dysfunctional business. So the way we approach things in the Pershing Square Foundation is we say, look, is there a for-profit solution to this problem? If so, we fund that one. And only if we can't conceive of a not-for-profit solution and we think the idea is a good one, the management is talented, and they're using business principles, will we back a not-for-profit? So just think of a for-profit example, and someone who starts a company that can take waste. There's a guy named Dean Kamen. Dean Kamen is an inventor. He invented the Segway. He's also invented a device the size of a relatively small refrigerator that you can put any kind of fuel in, whether it's oil or natural gas or dung or algae, and it will convert that algae into energy, so it will produce electricity, and it will produce heat. His idea is basically you take this energy little mini plant, you take some solar panels, and you combine it with internet access and a few other things that you might need in a small little town. You put them in a shipping, one of these containers, and you just drop it in sub-Saharan Africa, and it becomes, and he also has a device that treats the foulest water and converts it into fresh water. So you have energy, you have heat generation, and you have solar, and then you have internet access plus clean water. And Dean Kamen, the issue for Dean Kamen, he's a brilliant inventor. He hasn't figured out a business plan to get these devices introduced around the world. And actually, this device that creates clean water, he made a deal with Coca-Cola, and Coca-Cola is actually disseminating these water treatment little mini plants around Africa, just starting as we speak, and they're big red things, a lot healthier than the typical Coca-Cola drink, but I think their thesis is we start them on water, eventually we're going to sell them Coca-Cola. Anyway.
So you've given us lots of inspiration for what you all can do over the next 25 years. I'm going to ask one more question, and you should be thinking about the questions that you want to ask to Bill, because that's what comes next. I'm going to preference students first, and we'll, since we started a little bit late, we'll probably run over a few minutes. So Bill, I would like to welcome you to the Oxford family. This is not your home university. You'd spent a lot of time in Crimson, as I did, but I'd like you to think about this as your family. But this is not your real family. So I know when I hosted you and your wife this summer, you were a doting parent, and your dad is sitting over there. So what influence has your family had, both your parents and your other family, your own family, on the person that you are and the work that you do?
So let's start with Dad, because he's in the room. So my dad told me that I should never work for anyone else because they'll never pay me what I'm worth. And then he tried to convince me to work for him. And I worked for my dad for 2 years, and then I went to business school and I didn't go back. And he was upset about that, but ultimately, I think, that was a bit of the inspiration for being an entrepreneur. And I was an entrepreneur as a kid, and I had my car waxing business, and I had my ditch digging business, and you learn about the relative measures of different businesses. Only so many ditches you can dig yourself, and so on and so forth. So I had a very early business education, which I think was very helpful to me, and a lot of that I thank my dad for. My mom, I describe myself as the most persistent person in America, but actually that belongs to my mother. And it's usually when she wants me to do something that she behaves that way. But my mom, when I was probably 13 years old, she was very unhappy with the quality of the rail service to our hometown. I lived in a suburb of New York City, and we had these old 1950s diesel locomotives that were always late and literally had rusted holes in them. And my father would never get home in time for dinner, and the commute would take a very long period of time. My mother was very frustrated by this. And she joined this sort of nascent but failing kind of grassroots organization to improve the rail service. And then she made it into something. And she ended up running a petition drive. She got, 17,000 signatures, which is a lot for a petition. Went to Albany and ultimately ended up getting something like a $700 million grant to redo the entire rail system into an electric kind of modern day system. And my mom ended up going on the board of the MTA, which is the Metropolitan Transportation Authority in New York City. And people wanted her to run for government and everything else, but she decided to stay to raise her kids and be a mom. But I think it's a pretty inspirational thing for a kid to watch. And so I had from a lot of inspiration from Mom, incredibly persistent, unbelievably competitive. I'm a tennis player, but my mom is the most competitive tennis player. So you learn competitiveness from mom, entrepreneurship from dad. The other thing I would say is, I'll tell you the most significant, I think in the course of my life, what are the most significant moments? My dad won't remember this, but my dad's car, the tire, it had a tire that lost its inflation, and he asked me to change the tire, and he's standing right next to me. And our driveway was kind of like this. It was on a decline, and my dad's like, well, go change the tire. I said, Dad, I'm not going to change the tire with the car on a he said, no, it's just a very slight slope. It's no problem. I want you to go change the tire. I said, no, Dad, I think it's a really dumb idea. Bill, I want you to do this right now. And I'm, 14 years old. My dad tells me to do something. So I got the jacket at the back. I jacked up the car. I start to undo the tire, start to remove it, and the car gradually collapses. Fortunately, I get out of the way just in time. I'm alive. I didn't lose anything. But it was a very significant moment in my life, because even though he was my dad, ultimately, you have to make your own decisions. And so that was a very significant moment for me. I might have been 12. I don't remember when it was. But that was sort of the moment when you realize, okay, Dad's fallible. Okay, you can't completely rely on him. I'll give you one other. I'm giving away all these familial secrets. Let's leave it there.
To be continued. So, Bill, we thank you, but we'll thank you in a minute. This is your opportunity to ask questions. You won't get this many opportunities to get somebody of Bill's character here, and we're delighted he's spending this time here in Oxford. So there's mics. Who are the people with the mics? There we go. So since you were used as a prop in the conversation,
even though she's not a student, by
even though she, oh well, okay. Please. Right, and there is preference for students, but since I called this person,
you can always say I'm a student of life.
I'm not selling Herbalife or anything.
We can't hear you.
My question is very quick. I was wondering, a lot of critics say that activist investors sell companies and make a profit for the short term and not really for the long term. What is your response to that?
Sure. First of all, I would say there are lots of different kinds of shareholder activists. But I think the ones that are successful, because again, we don't buy control of businesses. We buy a minority stake. And if you think about what an activist does, we only bought 14% of Canadian Pacific. So 86% of the shares are held by others. The only reason why we were able to get and have the influence we had is because the other shareholders backed us. The other shareholders are big institutions that are not in it for the short term. They're major index funds and others who aren't looking for a quick 3-month profit. And they backed us because we have a track record of doing things to companies that create long-term value. And so we've made a lot of money in Canadian Pacific. We've sold some of our stocks simply because it went from being a 11 or 12% position to being a 28% position because of appreciation. But we've only sold stock because of portfolio management. And if you were to ask, all of the changes that have been made to the company's credit rating and has improved significantly, or its credit metrics have improved significantly, the profitability has improved significantly. The company's made, for the first time in its history, it has deals with all but one union, 5-year long-term contracts. The employees are happy, the railroad's functioning more effectively, their customers are happy. These are changes that are inure to the benefit of the company long-term. If an activist investor simply goes around buying a stake in a company and saying, sell yourself, I just think that's a distraction. And I think most businesses, you can create more value staying as public companies than you can by taking them private. I think businesses should only be taken private if they've reached the end of their strategic life, meaning that they've grown as far as they can grow and there's no more value that can be created as an independent company, and then it should be combined with some other business. But if you think about what private equity does, they make changes to management, they make changes to strategy, cost structure, capital structure. All of these things are available in the public markets. In fact, I think it's a failure when a company sells itself to private equity. It means that the company itself, the management, the board, and its shareholders couldn't figure out how to create the value on their own. So I think good shareholder activism creates long-term value. Bad shareholder activism pushes for short-term things that might create a bump in value on the short term but destroy long-term value.
Okay. Sorry. How about the person in the middle? Right. Yes, you.
Question, given your relationship when you worked with 3G Capital and Burger King, what was your initial reaction when 3G teamed up with Berkshire Hathaway to buy Heinz in February this year?
My initial reaction was they're going to make a lot of money.
just from the fact that there are 15 top-line businesses that make over 100 million, or from selling those off, or more of?
No, look, the way an interesting thing to do would be on a student trip. I don't know if you can make it all the way to Miami, but if you were to go to the Burger King headquarters, and you get off on like the 8th floor, there's no reception desk. You get off the elevator, and you walk straight out, and the first desk, which is a desk you might see in a 3rd grade classroom, just a flat desk with 4 legs, you could probably buy it at Kmart or something, is the CEO. And then about 4 paces to his left is the CFO, and 4 paces to his right is the chief marketing officer, and literally the entire senior management team is in a completely open space, no offices. Behind his desk is a sheet of paper. It's got the 5 key things he needs to accomplish that year. It's got green, yellow, or red dots based on his relative progress. This is the CEO's progress. And each of the senior reports all around the office have their own metrics on things they need to achieve with commentary so that everyone can see them. The printers are all set automatically to print on both sides. You're not allowed to print color. They never allow presentations where the background is black and the letters are white because it consumes too much ink and an ink cartridge. I mean, all the executives fly coach. They share rooms at cheap hotels. If you think about that kind of culture compared to the typical big American corporation of private jets and really a lack of regard to expenses, they're just going to find, I think if I remember, the company did something like $2 billion of operating income and had something like $9 billion worth of SG&A. My guess is that $9 billion number becomes 7 in relative short order, and the $2 billion of operating income becomes $4 billion of operating income. And they bought the company with a lot of leverage. Even though it was a junk bond issue, I think they borrowed money at 4% interest. So I think the total capital structure was something like 50% debt, which was at 4%, and Buffett put up this 9% perpetual preferred stock. And then the equity was only about 1/3 of the total capital structure. So when you buy a business like that with as much leverage as they did, and the leverage is long-term and on average very low cost and safe, the 9% is a big coupon. If they can't afford to pay it, there's no penalty for them paying it. It just accumulates. And you apply a cost-driven restructuring of the company, you're going to double and triple the value of that equity over time. So I think they're going to make a fortune. And since I'm friends with them, they very nicely allowed me to invest in the deal.
Okay, let's see. Maybe up a little bit further. Yeah, right by you, Victoria. Up there.
Hi.
Victoria. Yeah.
I have a question. During our times, who do you think is the greatest investor and why?
I hate to be boring on this. I do think Buffett is the greatest investor. And the reason why I believe that is, this is a 50-odd year, it's a 60-year track record of compounding at 20+% with a very modest amount of leverage, in the form of principally insurance float. And I just don't think there's a record that compares. And I also think that what he does actually creates value for the world. I think George Soros is an incredible investor, but I think what he does as an investor creates no value for the world. No, I think what he does as a philanthropist, I think he creates a lot of value. So I think Buffett has the benefit of, I think Heinz will be a much better business by the time, as a result of Buffett's ownership. You look at what he did with Geico since he bought it. I think he's created enormous, he's bought businesses well, but not incredibly well as he's gotten to be quite large. But he's made those businesses much more valuable. And I think he's also created a lot of messaging that's affected the way people think about executive compensation and derivatives. So I think he's made an enormous contribution. So I think it's a combination of long-term, kind of longitudinally, and the accomplishments he's had. So I think he's the best, by far the best.
Okay, maybe 2 more questions.
I'm happy to do more.
I
won't run out of energy. It's up to you.
All right, so we're probably going to have to, because, so let's...
Someone else wants the room.
Yeah, someone else wants the room, Bill. How about this young man over here?
Okay, how about a really hard question? What do you got?
Okay. I'll try. You spoke about how dealing with failure has defined you. Had you not failed, how do you think your decision processes would have been compromised? And can there ever be long-term value in engineering failure?
Okay, hard question. No, look, I don't know that I've, every day, over the course of your existence, you make various mistakes, whether it's socially or whether it's in business. But the ones you really remember are kind of the bigger ones. So the JCPenney one certainly got a lot of, the problem with our strategy is we're very concentrated. We manage 11 or 12 billion of capital. So when we make a mistake, it's going to be really big, right? The numbers are, we lost $500 million on JCPenney. Well, that was 4% of our capital. Now that sounds a little smaller, but that's not how the press is going to present it. But it's very, very helpful to have mistakes that you notice. And so I wouldn't run around engineering mistakes. What I would do instead is to value them, right? I think the natural tendency when you make a mistake is to try to forget it as quickly as possible. When what you should do is the opposite. You should study it. And business schools, the case method is largely about that. A lot of cases are, what should you do in light of a failure or a mistake? And that's why it's the best kind of mistakes are ones that you can practice with, theoretically. But the ones you really, really learn are the ones where you feel, something in your stomach or in your wallet or some combination of the two. Well, look, I think one of the biggest mistakes our generation is making raising kids, I don't know how many people in the audience are at that stage yet, is I think that an ability to deal with stress, what people call grit, for example, is a bit lacking in our kids' generation because I think there's a bit of a tendency on the part of the parents to keep saving our kids when they're about to fall. Everything from the way playgrounds are designed, where if you fall, well, it's cushioned, but it's kind of an extreme example. I mean, you don't want daggers lying around on the ground, But I do think that we're cushioning a bit too much our kids, and we should allow them. My wife is a landscape architect, and some of the kids love there's a playground called the Adventure Playground in Central Park, which would never get built today because the litigation plaintiffs probably have a field day with it, but the kids love it because it's actually challenging. And so I think, I don't know about engineering mistakes, but I do think not saving your kid, they went into a class this year and they end up with they have no friends and they hate their teachers. Well, you could move them to another school or you could do that, but making them suck it up. Or they're on the the volleyball team and the coach never plays them. Do you go to the head of school and get them to fire the coach, or do you say, hey, life can be like that, and you have to deal with it? So I think that, yeah, I think that, yeah, we need a little bit more Darwinism. All right,
one last question.
Darwin was right, by the way.
Darwin was right. The woman in red in the back.
Well, I can tell this is a risk taker. This is the only person in red in the entire audience.
Hello, I want to ask you, as a hedge fund manager, how do you define hedge fund in the most simplest term, and what's your opinion on insider trading?
Okay, so a hedge fund is actually it's really an incentive structure. So a hedge fund manager compared to a institutional manager is compensated largely based on the profits. So we get 20% of the profits from managing capital. Now, what a hedge fund manager does is very, very broad. It's everything from being an activist shareholder to being a commodity trader to being a macro trader to being a short seller. So it's really a compensation structure as opposed to an asset class, and people sort of make that mistake. My thoughts on insider trading, I think it's very bad for the hedge fund industry to have a story every day in the newspaper about some hedge fund manager who's either accused of insider trading or has committed insider trading. I think that's an unfortunate thing. There's some interesting debates as to whether there should be something. There are people who have made the argument that insider trading should be legal. In fact, that would increase the chances that security prices accurately reflected their value if all the inside information was allowed to come into the market by participants. I think the problem with those kind of arguments is that if people believe the markets are unfair or a rigged game, then the largest source of capital in markets, which is the retail investor, will basically step out of the market. And so I think the rules are generally the right rules. The problem I have with a lot of the regulation, at least the way it works in the United States, is there's a lot of people who are accused of a crime where that accusation is made in a very public way, it's leaked by a regulator, et cetera, and that puts enormous pressure on the individual to settle, and also harms them reputationally in their business and otherwise. And the government has enormous power versus any individual. And I think that dynamic is a bit of a dangerous one. And I think all investigation should be private. And if ultimately someone's adjudicated to have committed a crime, then fine, it should be in the newspaper. But I think this notion of using the press, and again, I don't know Steve Cohen well at SEC Capital, but if you followed the press on SEC Capital, ultimately, with respect to Steve Cohen himself, there was never any evidence presented, at least publicly, that he was guilty of anything. But there was enormous pressure brought to bear on him, to settle, and it destroyed his business. And we'll never know. It takes years to find out whether someone's guilty or not. So I think that whole dynamic is a very unfortunate one.
Bill, thank you very much. From convertible preferreds to parenting, from investing to philanthropy to what government should do, thank you for giving us a window into your life and your thinking. And thank you for making somebody out here, and some of us, given the ability to change the world by being a scholar in the name of Pershing Square. Thank you so much, and I can tell you, as a professor, to see your student succeed beyond all of your wildest expectations is probably the highest accomplishment that an educator can ever have.
Everything
so
I know I learned from Peter.
Excellent.
So what do I want to minimize? The risk of something bad happening. And what do I want to maximize? Happiness. And where does it come from? Fulfillment, relationships, self-actualization, achievements, things like this.
Can I be blunt? You appreciate happiness when you have it. It's very hard when you're on a treadmill. You look back to sharing that apartment with David, having a 3 million fund. Now, if you could see yourself back then, you'd say, you have everything I could have dreamed of and more. Do you appreciate that happiness when you have it?
Of course. And by the way, I've been consistently happy pretty much since birth. So I've had volatility in my career. I've had volatility in my marriage, and now I'm now married again. I've gone through challenging times. I've experienced sadness and loss and all those things. But I think the undergirding support here is happiness. I'm an optimist, and I'm a happy guy. We took about $1 billion position in Netflix after the stock fell about 50%. And then, we're a long-term investor, but we learned information within a few months of the initial investment, i.e. the next quarter's results, that caused us to question our entire thesis on the company. And we exited and promptly lost, $400 million, or something along those lines. So that was a more recent one. But I think what's not written about in our letters, but I consider, with respect to COVID, I had a very early view what the economic implications of COVID would be, or enough of an early view, month, 2 months, not more than that, that enabled us to make a fortune hedging COVID. I had a very similar view about interest rates, and we were completely ahead of the curve. And the mistake was not making that a bigger bet. We should have made $10 billion on hedging interest rate risk. Instead, we made $2.8 billion because we were a little timid. So some of the mistakes we've made, well, we had a pretty, variant view that we were quite confident in, but we didn't put enough capital behind our confidence. So
how do you think, sorry, I'm fascinated. How do you think about position sizing? You always want more in your winners. You always want nothing in your losers. How do you think about position sizing?
So the way we think about it is we're willing to risk a certain amount of capital on any one investment. And so if you're investing in the world's most dominant music company, Universal Music, it has very little debt. it has a great market position, and you can predict the business with a very high degree of confidence, and you're buying it at a fair price, you can assess what's the chance of our losing, 25% of our investment, over a several year holding period. And if the answer is very close to zero, which is kind of our assessment, we can make an investment like that quite large, right? If you think about, well, if we're risking 20, let's say the most we could lose in our view on that, not just a daily mark-to-market loss, but a permanent impairment, what would have to happen for us to be permanently impaired to lose 25% of our capital in that investment? Something pretty extraordinary. So that kind of investment can be 25% of our assets because it's something where the risk of loss is very diminished by virtue of the robustness of the business, the capital structure of the company. Whereas you're buying an interest rate derivative, we bought, in effect, the way to think about it is we bought a call option that paid off when 2-year interest rates went above 93 basis points. And we had about an 18-month term. And at the time we bought that instrument, 2-year rates were at 12 basis points. So it's a bit like buying a call option on a stock. The stock is 12 and the strike price of the call option is 93. It looks massively out of the money. And there's a fixed time frame, right? So on something like that, the risk of loss is high because just to break even, you've got to cross, the yield, if you will, has to go up, 9x or something, right? 8x to get into the break even territory. And so something like that we make quite small. It was about 1.5 points of our, a little under 2% of our capital. But could it have been 3%? Could have been 4% for sure. And so when I look back at something like that, I would have been willing to lose more, but we had not been an active participant in the interest rate derivatives market, so we were a little timid. Timidity has held back our results for sure. And I think what's interesting about those kind of bets is when you find a hedge that will protect you if rates rise, but it's also a really interesting investment on a standalone basis. Like you'd make it even if you didn't own a portfolio, because you said, look, on a standalone basis, the payoff here is massive, right? If our views on rates kind of hold, you can make those larger than just a pure hedge, right? It's a bit like, you don't want to spend too much money on insurance, otherwise it's too expensive to live in your home, right? You don't want the payoff on your insurance policy. Like if the storm comes, you collect $10 million for your $2 million home. You can't even do that today, but let's assume you can. But if the insurance if you knew that there was a storm coming, the insurance company was still willing to sell you that homeowner's policy at the same price as if there were no storm, you should overinsure. And so I think our only mistake there is we could have overinsured a bit more because we knew a storm was coming. We get so much shit, if you will, when we make a mistake because they're always big, right? We're concentrated. We're managing $15 billion. We're putting 10, 15% of our capital in any one investment. So if we lose, 25% on something where we have $1.5 billion, it's a $400-odd million loss. That will make the headlines, right? So we're going to get pummeled for it. So every article I read recently about us is like some investments we win big, some investments we lose big. The reality is 90% of the investments we've made in the last 20 years have been profitable. In fact, meaningfully profitable. We've had a handful, big blunders, big headlines, but they've been a small fraction of the what we've done. Otherwise, we wouldn't. The compounding doesn't work. We make a ton on this one, we lose a ton on that one. But the headlines imply, like no one writes a story when we've owned a stock. We paid 12 for it. It's now 60. We've never sold it, so there's no visible gain or loss. That's restaurant brands. But no one writes a story that we've made, billions of dollars investing in that company because there's nothing exciting about it. But if we lose $400 million in 3 months on Netflix, it's front page news. So I would say originally it was a very important part of the strategy. We were a tiny fund trying to influence these really big companies, and we were using the power of persuasion to influence them. And we couldn't influence them with the fact that we own 1% of company ABC. But we could if we corralled the other, substantial majority of other shareholders to our views, and therefore having the platform, if you will, or the mouthpiece was how we effectuated change. So it was a very important, powerful part of the strategy. And then I always had this kind of free speech thing. I don't want to copy Elon or anything, but big believer in free speech. And if I think about the most important drivers in my life, I would say independence was always one of them. I did not like the fact that my parents could control me, and that motivated me to have lots of summer jobs, so I had my own spending money, and that also motivated me to be financially independent as promptly as possible. But one of the sad things about our country right now is I think free speech has been crushed to a great extent, other than if you're, if you can say something, if you could express a political view and get fired today, which is definitely a very real possibility, only if you're financially independent or, an entrepreneur of some kind, or you've got enough money in the bank, can you take the risk of speaking freely. So I take advantage of the ability to speak freely.
But I think what people forget is, Wall Street has, unfortunately, in the last, certainly since the crisis, gotten a pretty bad name. But Wall Street is responsible, is probably the biggest engine for job creation, enabling businesses to access capital, enabling businesses to grow. I mean, you look at Howard Hughes was a creation out of thin air. It's now a business that employs, it's going to ultimately employ thousands of people, create a ton of jobs.
Do you think the criticism of Mitt Romney during the campaign for his activities in running a private equity firm were unfair?
Yes, absolutely. I think good private equity investors create a lot more economic value than they destroy.
And grow more jobs than they save?
They grow a ton of jobs. I think the biggest risk with private equity...
Save jobs that would be going away.
The biggest problem with private equity is there are periods of time with private equity firms use too much leverage, which puts too much pressure on a business and risks a business's failure. Mm-hmm. Putting aside that, I think the top private equity firms create a lot of economic value.
Too much leverage and too much was part of the problem of the economic recession we went through.
Mm-hmm. But we're not going to save the country with philanthropy, despite the fact I'm philanthropic. I don't think that's going to solve our economic issues.
What will save the country?
What will save the country are good economic policies that create the right incentives and a administration that's supportive of the business community. I think that's actually very, very important. And policies that will make us competitive globally. It's a global economy. There's a story today, I think, in today's journal about companies merging with European businesses to move their operations offshore from a tax point of view. We have to have a tax policy that discourages that kind of activity.
So you can bring the money home.
Yeah, I mean, I look at the United States.
Is that the idea? Have a tax policy so that the money can come home rather than leaving it offshore so you don't have to pay taxes on it?
Yes, but I think if the United States is not dissimilar to the kind of companies we invest in. We invest generally in very good companies that have lost their way. And with better management, enormous value can be created. If you look at Canadian Pacific, this was a dying railroad.
That's one of your investments.
It's a dying railroad under Hunter Harrison in a very short order. Less than a year and a half, he's made dramatic changes to the business. The president is the CEO of this business that we call America. And the decisions he makes with respect to the way incentives are designed, the way he works with Congress as a leader in effectuating policy change can make an enormous difference in the growth rate of the country, in job creation, in happiness, in our safety. I think that we can't diminish the importance of business and business practices. I mean, you look at what Bloomberg has accomplished as a mayor of New York City. He took his for-profit mentality and has applied it to a city. And I think the city has accordingly thrived. I'd love to see the same thing happen for the country.
It's tough management, too.
Yeah. It's also, he has the benefit of independence.
Financial independence.
It's an enormous benefit.
So you're not obligated to anybody particularly.
Very important.
So we should not elect rich people?
No, but we should, I think that there's a lot to be said to have someone with a business background making decisions about the economy.
Just because I don't quite understand this, I mean, is hedge fund performance down?
Yes. If you look at the overall statistics, yes.
And why is that?
The answer is I think there are a lot more participants. I think that there have been...
So it looked like it was just a sweet place to be, and it's less sweet now.
It's become a much greater percentage of the amount of capital that's invested,
right.
And the scale, by just the math, makes it harder for that capital to grow at a high enough rate. I also think there's been some regulatory change that's made it harder for certain kinds of hedge funds to make money. I think it used to be that people could
You hear of hedge funds that would just, ask enough questions that they would get answers ahead of the market. I mean, there was some bad behavior that took place, and the government put in place.
We've had some insider trading issues as well.
Yeah, and I think a lot of the crackdown on that stuff has maybe taken away some of the bad returns from the business. But I think the biggest driver has been the fact that the business has scaled. But look, it's just like the mutual fund industry. As a collective, it's not particularly attractive place to invest your money, but there are a few very good mutual fund managers who've done a lot better than the market over time. Same thing's true for hedge funds. Same thing's true for investors in real estate.
If you weren't an investor, what would you be?
That's a good question. I mean, I would do what I do now, even if I weren't compensated for doing it, because I think it's a way for me to make the biggest contribution that I can make. I mean, look, I think about government if I could effectuate change the same way I can effectuate change in the private sector. But I think I can have more influence as a private participant than a public participant.
Thanks for coming.
Sure.
Bill Ackman, back in a moment. Stay with us.